Okay. So for the last time that we have here, let's just walk through the business. What does the company do? Um, uh, let me just because what I want us to think about is valuation. We're gonna start. I want to start with a market multiple. So we're gonna do this a little bit differently. Let's think about comparables. Think about what we would pay for the business, right? On a market multiple basis. Let's select that. Let's leverage the business. Let's do a capital structure based on that. Then let's do the financial statements. Then let's do the DCF. And then we'll see how they compare. Does our DCF match our market multiple? Does it make sense? Doesn't it make sense? Okay, does that make sense? We'll do it that way. You like that, Peter? Yeah, okay, good. So this transaction represents an opportunity to support a company with market leadership and industry growing leading brand recognition. Unique value proposition to employers and employees, diverse and long-standing relationships, favorable industry tailwinds, strong financial performance and high free cash flow model, and impressive management team. So what kind of jumps out at you so far? Like, what is this, do you think? Why did they write this like this? What are they looking at when they're making an investment? These are characteristics, right? These are business characteristics. This is what interested them in the business. So let's take it step by step. Market leadership and industry-leading brand recognition. So they have a strong market share, right? What's market share? What does that mean? If I told you a market T-shirts is $100 million market, and I generate 10 million in revenue in that market, what's my market share? 10%. So if you're a leading market leadership, it's probably higher than 10%, right? Favorable brand recognition. People know your brand. It's known. It's a well-known company. Unique value proposition to employees and employers. What does that mean? What is value proposition? Anybody have any thoughts? Anybody have any thoughts on value proposition? A value proposition is just simply the value that you're delivering to your customer. So it could be value on price, right? It could be just straight price. It could be value on quality. There could be multiple different ways you're providing a value as a proposition to the owner of that product. Diverse and long-standing customer base. So when we think about risk, we think about, if I told you and you didn't know anything else, a company has 100 customers, 3 customers make up 50% of the revenue. All right, there are 100 customers, 3 make up 50%. Would you think that's risky or not risky? And why is it risky? Right. So if you're a lender, what off the bat you're going to charge a higher or lower interest rate for that business? Right. Just knowing nothing, right? I mean, this is immediately a big deal. I'm going through this right now with something that we're looking at. They have a lot of this is called customer concentration risk. We're looking at a deal. There's a lot of customer concentration, and we got to figure out how to price it, because if they lose a customer, it's a problem. They're gonna have a problem. What happens if one customer makes up 50% of revenue and 50% of EBITDA? If they lose that customer, what happens? Right. Or revenue should drop 50%, right? If you make 100 million, one customer gives you 50 million, and you lose that customer, you lost $50 million. It's just simple math, right? So that's the issue. Favorable industry tailwinds. So what does that mean? What's favorable industry tailwinds mean? Yeah, like the industry is doing well. You're in an industry that's like, if you were to open a business today, what would be a great industry that you'd want to be in?
Any way to get food
Fast. Yeah. Oh, yeah. Okay.
Anything fast.
Anything like food delivery, right? Yeah. This guy good. Like, forget about the business economics. Let's just think about industry. What else?
Like masks. Like making masks.
Yeah, making masks favorable, right? I mean, who knows how long we're going to wear masks for? Yeah. What else? Vaccines, you're going to start making them. But yeah, but healthcare. How about just healthcare in general, right? The population is getting older in America. People are going to need more hip replacements. Hip replacements, you need orthopedic surgeons. Orthopedic surgery, great place to be, right? It's an industry tailwind. Older people break hips. They need hips replaced. Orthopedic surgeon, probably the best surgeon to be over the next 20 years. I don't know. They're going to make a lot of money. What's that? Life alert. Yeah, there you go. That's a good example. That'd be a great business now. People are getting older, population is getting older, they need that. Yeah, exactly. Falling and you can't get up. Financial performance, high free cash flow, and impressive management team. So these are the kind of the tenets. So now let's think about it here. So it says the company has the #1 market share among restaurant employees who wear slip-resistant shoes, with a 17% share across the food industry. Biggs is the brand choice amongst customers, aided awareness of 50%, is recognized by employers and employees of superior product performance. So #1 market share. It's very important, right? What are the immediate pings for you? What do you start thinking of when you just read that sentence? Is there anything that's negative to you? This is when I talk about thinking analytically, thinking like an analyst. What immediately kind of just pointed out to you there? Anything?
Very particular customer.
Very particular customer, and that is restaurant employees, right? What's restaurant capacity right now? What's that? Yeah, so what do you think their business did during COVID? Right. I mean, I don't know because we're going pre-COVID.
Everyone would have done food delivery, but not necessarily on the in-person restaurant.
Yeah, so some guy or girl selling food, Uber Eats is probably not going to care if they have a slip-resistant shoe on, right? Why is slip-resistant shoe important in the restaurant industry? Has anybody ever waited before? Yeah. I've waited tables before. Why? So anytime you're in a kitchen, just a little digression. The kitchens are always slippery, right? It's like oil and there's water and you're a busy restaurant. If you're a waiter, obviously, when I work in a busy restaurant, it's just slippery. The environment is slippery. So having a slip-resistant shoe is a benefit to you. All right. Sticky business model leads to recurring revenue stream. So it says 78% of total big sales are derives from PDP programs where the company and the customer set up an agreed upon buying program for employees to purchase the company's shoes. The model is highly attractive to the employee, and the company. Value proposition is exemplified by low churn within the business, which only amounts to 3% annually. A lot of terms there. It's really important. A lot of terms. And I'm really happy just stepping back a bit. You might find it a little bit boring or tedious to read every line, but the thing is, you are going to get this type of stuff. You've got to understand what this stuff is. Not that you can't just Google it, but it's just good to get a sense of it now because it's going to come up later. So what is churn? Does anybody know what that means? When?
They go through customers.
Right. So if I told you my churn was 100%, what does that mean? Right. That means for every customer I gain, I lose that customer. If my churn is 0%, I never lose a customer, right? So risk and return. Where would you rather invest? A company with high churn or low churn? Low churn. They don't lose customers, right? This is very important. They don't lose customers, so it's very important. The PDP program where the customer and the company set up an agreed buying program for employees. So what that really means is that they have almost a supplier relationship with the restaurant. So if you work at a restaurant, let's say you work at McDonald's, they would say, hey, you're a new employee at McDonald's. We'd like you to have these shoes from this company because we don't want you to slip and fall and get hurt at work. That's what that relationship is. The value proposition. We talked about this a bit, but This is the value to them. It is minimize slip and fall, reducing out-of-pocket costs and workman compensation expense as much as 80%. So what does that mean? They can go to McDonald's and say, hey, if you use our shoes, you have less injury, which means less cost to your business. That makes sense? This is the value proposition. They're creating value for them. Superior technology. They far exceed the competition, yielding 50% more slip resistance than the next performance and more than 11 times the worst performance. So this is kind of like I just read that and I just think, they could be stretching the truth here, right? Because how would you test my 50%? How do you know I'm 50% less slip resistant? How do you test that? What is 50% more? I picture like you put it on, some guy goes like that versus some guy falling on the floor. Is it's 25% more? No, honestly, I don't know if that is. So it's just like this is the stuff, right? This is the kind of stuff. 2008, this is restaurant units were flat and fell 40 basis points. 2009, FSR, which is full service restaurants, unit counts increased modestly in 08. So they went and they compared versus a really bad time in our financial or economic history. And what they're saying is that it only declined 1.7%. The food service segment is projected to grow 780 million in 14 and to 1 billion in 2020, coincidentally, representing a CAGR of 5%. So what they're saying is like, hey, we got a good industry. There's more restaurants opening. Even when things were really, really bad, they were okay. All right. We got the strong financial performance, which we know what that means. Free cash flow characteristics. So we talked about this, but this is good. This is all talking this all over again. Margin profile, minimal capex, and low working capital, right? Talked about all this stuff. This is everything we talked about. That we covered all of these topics. So you should know right away, okay, I get it. And what it's saying is that convert a significant portion of its EBITDA to free cash flow. Because what will come out of EBITDA? We're thinking, remember with the money we got to spend, or the two things we talked about, capital expenditures, right? And then what was the other one? Working capital. What are we going to buy? What do you think their working capital is when they're buying? What are they buying, you think? They're buying, they got to make shoes, right? So, like, what do you think they're going to buy? Soles, rubber, right? Like leather, I don't know, Velcro, laces, right? This is the stuff to make the shoe. So that's going to be their working capital, right? Don't ever get confused about things in finance. Finance is, it's a game that is meant to confuse, I feel like sometimes, like when you think about it and somebody says, well, what's their inputs? What's necessary? Just think about the business itself. What do they do? And then what makes up what they do? And then you're going to start to figure that out in your head. Management team. The company has managed by industry leaders since its founding in '84. Under new management structure, the company has grown revenue and EBITDA from 155 and 34 to 183 to 47. So a couple things that may or may not be a good thing, and I don't know if they are. One, it says new management team, right? So the founder's gone, most likely, right? So you lose that founder alignment. Someone created this business in 1984, and they obviously created relationships. So these are things that, again, you like to have them in there because they've created those relationships. They've helped build this business. Okay, now I'm just going to, now let's think about it. I'm just going to hide that a little bit. What are risks? Let's think about risks here. I just walked through every single line item of that. What are some risks in this business? Can somebody give me some risks? Restaurants closing, okay. So closing for good, closing for short term. What do you like? What do you? How are you thinking about that?
I think both is pretty more risky than the other.
Right. So short term, yeah.
Lawsuits, like the supply chain thing that happened, about the ship.
Right. A disruption in your supply chain. Yeah.
Popularity of based on how many people are actually going to use their shoes.
Right. You mean like brand popularity? Yeah. Okay. Right. Mobile ordering, less people in the restaurant, less employees. That's fantastic. That's huge. I didn't even think about that one. Yeah.
And they left out the biggest one, like the competitors. Like, of course, this is all pointing out positive stuff, but, who else is there?
Right. So this is key because, so we'll talk about process. When I get a deal, comes across my desk, this is my job. I have to create questions. I have to talk to management. So this is your job. You were literally just doing my job. That's what I have to think about. Mobile ordering. You have to position a question. Hey, more people are buying, and you have to kind of be nice though, right? Because like you're trying to partner with them. You're trying to give them money so you get return. So you can't be like aggressive on it. But you want to just be like, hey, I noticed that a lot more people are ordering at home now. How's it affecting your business? Rather than being like, oh, this is a disaster for you. So you're gonna just like think about it that way. One of them was, what was your brand?
Brand popularity. Like, how do you plan on exposing this brand to restaurants when COVID is going
Right.
on?
But you know what that would be? That would be like a diligence request. Hey, you guys noted that you're number one brand popularity. How'd you measure that? Do you have any documentation to support that? Can you send me some documentation to support your brand popularity? Right? You're going to be an investment maker. Private equity funds are going to ask these questions all day long. Like that's going to be you. So you want to think ahead and ask the client, hey, do you have this? Like, what's going on? I need to know. I need to understand this kind of thing. Right? What were some other things we were talking about? Competition, right? And how would you position that question?
So we're saying that after you launch this product or ask money to make the product better, what about the other competitors? Are they going to make it better to be much better than yours?
Yeah.
Or
Right.
they're just going to stay the same?
Right. You just think like, hey, you guys look like you have, and even better way, you have this amazing business. Since your business is so amazing, what about competitors? Don't you think some other competitors might come in this? So you're kind of propping them up and then just bringing them down. But it's a little bit better to say, hey, put it that way. Hey, you created such an awesome product. Can somebody steal this from you? What would be the best response? If you ask me that question, slip resistant. Exactly. That would be the next question. That would be a sub bullet. Is this patented? Right? Because if they said yes, that would reduce your worry on competition. Right? If they said no, it would increase your worry about competition. Right? Yeah.
So let's say that they did a patent for their product, and they're saying that their product is much better to the current trends of whatever people are saying. What if a different brand comes up with a better product than the one that's asking money for? How do you identify that?
Yeah, you would hire a patent lawyer, or there are patent lawyers that are going to be hired. So the private equity firm that would buy this business, they would go hire a patent lawyer.
Okay.
They literally would hire a patent lawyer and say, hey, this is not a private equity firm is not patent lawyers, so they're going to go hire that firm. They're going to go look through the patents. How good are the patents? And realistically, in China, they rip them off anyway. Doesn't make a difference. Patents or no patents, don't really care. I worked at the company in my old job when I was a banker that they made testing chemicals for flu, COVID. So we don't do the swab and they throw it in. They would shake it up in this chemical, and that would keep it good for a while, so they could transport it to a lab, and then the lab would test to see if you're positive or negative for COVID. Our clients had 50 patents. They had a patent attorney on their that they worked for the company. Okay, Chinese ripped it off left and right. I mean, didn't care. They had patents in China. It didn't matter, And this was a big thing for private equity. Private equity would come and say, look, this is great. You have a great product, amazing. They would keep your COVID sample completely the same as it was taken out of your nose. Like, very rare that people can even do that. There's a lot of reasons why you had these false negatives or positives in the beginning. Remember, maybe they were positive or negative. There was always an issue. This company kind of helped that. Private equity firms, a lot of them said no. They said, hey, look, it's a great product and it's awesome. We just can't trust that the Chinese just don't rip, they continue to rip this off. We're not trusting that is the case. So they go through that process through a lawyer. They had to hire a lawyer. So that was good. Okay. So let's look what they noticed. Competitive landscape. So they're saying that there's a wide range of players, including major discount chains as Walmart and Payless, branded wholesalers such as Skechers, and direct competitors with the same model. So what are we talking about? Competition, right? That's what they're saying. But what now? The next is the mitigant, because if you are a lender or you're a private equity firm, you're gonna buy this. Remember when I said about investment committees? You got to get this internally. It's got to get passed. Somebody's got to pass this. So if you really like this deal, you got to come up with why that's not a big deal. Yeah, it's a risk, but here's why they're going to overcome that risk. If you can't overcome that risk, you're never going to get a deal passed. You're never going to be able to go through this whole process. And your job is to do deals, right? So now it says, according to a third-party study conducted by Gore, so someone else did a third-party study. It may have been paid by the private equity firm. It may have been paid by the bankers. I'm not really sure. It may have been paid by just the company itself. The company is a clear market leader, 70% of revenue in the food market segment, with high brand awareness and strong end user feedback. So what do you think about that as a mitigant to what they just said? So remember we said competition, Skechers, blah, 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 and they're offsetting that by saying that, well, we did an outside study and it's #1 brand. I don't know, man. Like you're the investment committee. Would that pass muster for you guys or not?
We could have went to some of their friends and said, hey.
But that's good. That's you. Right, but what will your question then be to me, the deal guy? I'm proposing. Who did it?
Can I see the data?
Yeah, exactly. I'm not comfortable with that. Who's Gore?
Yeah.
Do we even know who they are? Did we talk to Gore directly? Do they have any relationships with big?
Other companies, like,
Yeah, exactly. So, right, this is the thinking. Modest volume declines. The company experienced 2.7% and 1.8% decline in total food service volumes in 13 and 14. Continued volume erosion in this segment would have a negative impact. So they're saying that they did have a decline in food service volume. And they're saying the mitigant here is that their customers have embarked on refranchising programs in an effort to reduce corporate ownership and increase profitability. Management and SIC, which is like the let's call it the private equity, have indicated that most of the refranchising has already occurred. So they're saying, yeah, there was a decline, they refranchised, but I don't even know if I understand that quite thoroughly, what they just said there. Because they're saying there's a decline in food service volume. Because they embarked on refranchising programs. Does anybody have any thought? Pete, you have any thought about what that means?
No, I see there's actually that going to the west.
I guess. I guess it's more of a closing of stores. I mean, that's maybe what it is. I don't know. I'm not even sure. So that'd be a question. You're a investment committee that you'd ask the deal person, the guy who's the analyst. Hey, what does that mean? I don't understand what that means. It's not clear to me. Technology risk. We talked about that, right? And then look what they point here. The company's outsold provider provides superior traction on all wet floor, blah, blah. The company goes to great lengths to protect its proprietary technology as a trade secret by owning its manufacturing facility in China. That's weak, right? Is it weak? Is that weak to you? So you own a facility in China. It doesn't matter.
Yeah, you own it for 8 hours a day. The other 16 hours are making everyone else's stuff.
Right, exactly. So they say, hey, we own the facility. There's no stealing of our technology, is what this is saying. All right. The vast majority of discretionary purchases. The vast majority of the restaurant companies do not purchase footwear directly for their employees, and the employees are required to pay out of pocket. So this is a big deal for me, right? Why is this a big deal?
People don't make a lot of money in the restaurant, so like if someone comes along with anything that's less expensive, you're done.
Right, and also, do they need to buy the shoe?
Yeah, I don't know.
No. See, remember we talked about earlier, they had this PDP relationship with this. So I was thinking, oh, okay, that means that the employer buys your shoe. Because then that'd be interesting. Hey, I walk to McDonald's, I'm here day one. What are they going to ask me? What's your shoe size? And they're going to buy me the shoe. That's good business, right? For the seller. Now you're telling me the employee buys the shoe. I don't know. Do they need the shoe? Do they have to buy the shoe? Is this mandated that they buy the shoe? This is the question you have to ask. Does McDonald's help subsidize the shoe purchase? Do they at least come up with half? You know, again, questions. These are things you have to ask. Hey, is this subsidized? Does McDonald's pay for half? Does, I don't know, Fridays, Applebee's, do they pay for some of this? So this is important. What's their mitigant? Employers are highly incentivized to increase participation because of the slip and fall in workman's comp. The majority of customers have well-defined safety policies with safety managers encouraging them to buy. It's not a good response, in my opinion, right? Because they're saying that they're encouraging them to buy. It doesn't mean they have to buy, right? Margin sustainability, raw material. The company's gross profits have increased by 200 basis points. They have exposure to raw material, including foam, rubber, and such shifts in cost of these inputs have an impact on the cost of goods. According to management, the company is able to successfully pass along price onto customers. So this, just so you're aware, the deal person or team or persons are, you see these risks and mitigants, these are the questions they had. See, I do this, right? So I have these questions and I ask, and then they give me these answers because I know that this is going to come up. We're going to have a problem here. So what are your thoughts about that? What are they saying? How are they offsetting any fluctuation? What's that? They're passing the price to the customer. And what did we just say about the customer?
You might not have customers.
Right, but who is the real customer? Right. So now we're saying it's person at McDonald's. They're making minimum wage probably. So now we say if there's price fluctuation, what are we doing to them? Charge them more, right? So how do we feel about gross margins then? Right. And we're going to think about this when we're modeling this. We're going to model in some downside scenarios. Well, what if they can't pass along that price, right? Potential warranty claims. So they offer up to $5,000 to $10,000 of out-of-pocket. Okay. I never even read this one. They reimburse up to $5,000 to $10,000 of out-of-pocket medical expenses per slip and fall in the event that they're wearing this. If there's an uptick in slip and fall, the company will have exposure to warranty claims. The company has incurred only $206,000. Okay. They've paid out less than $2.5 million since 2009. I never even read that one before. Did you read that one before? So do you think that's just good? So what do you think about offering that? Like, let me ask you this. You wear this shoe. You slip and fall at McDonald's. You have $5,000. What do you think has to occur for them to pay you? Like, yeah, then how would you prove it to them that was because of their shoe? Can't they argue like, well, maybe, he spilled water and you slipped because of that? Like, oh, but it's the anti-slip, they spilled a lot of water. How much water was run off? I mean, this is like a crazy thing, So to me, it's crazy. I mean, so there's two things. Why are they offering that? Why do they even offer it as a company?
Even though they're saying it's the best product, they still have not 100% reliability of their own product.
Well, but what is it to the customer that makes that even more appealing? What does that tell you about how they feel about their product?
It's a great product.
It's an amazing product, right? You're never going to slip and fall. If you slip and fall on you, I'm going to give you $10,000. It's kind of insane, right? Like, I can't believe that's even a practice. Like, right? Why would you want that? And they're saying, hey.
But are they still kind of compensating on that restaurant people? They're supposed to have like what is one? So you slip and fall, it should go to the restaurant first, and then they'll just
and go through workman's comp.
And
So
proof that it was shoes,
that's good. See, I didn't even think about that, and this is why. So almost what you're saying is it might just be a BS offer anyway, because even if you slip and fall, and even if you get hurt, you're not going to pay out of pocket. It's going to go through your company's going to pay for it anyway. So this is almost a false.
Probably pay more in lawyers than people that
Right. You have getting a good feeling for something we're never going to have to pay anyway. But now, so the mitigant though here, that's really smart because the mitigant, what they're saying, right? The investor is saying, hey, they've only paid out 1% of revenue. So this is good. But to your point, but maybe there's really a world that never even is going to happen anyway. So he's really 1% even good or not good. You don't really know, right? And then this last one says the leverage request reflects leverage of 6.75 times LTM, which is the top of the leverage multiples for similar size businesses in the market. And it says the mitigant is they have a lot of cash flow, they have little capex, they have significant tax attributes. So $4 million of annual tax shield from step up, from amortization from this deal. And the company has consistently paid down debt since the last LBO and continued to leverage. So what's a tax shield? Anybody familiar with that? Amortization is just, again, remember we talked about depreciation and amortization. They're able to amortize quite a bit to reduce the amount of taxes they have to pay. So if they pay less taxes, that means more cash flow. And if more cash flow, they have more opportunity to pay down debt, right? Okay. Good. Okay. So, yeah. So this goes a lot more into the investment merits. But we're going to kind of start to dig into this one. I think I'm gonna end this now. We're good. Yeah. Okay. Because this is like a transition now into another, which is where we're gonna have to pick through this. We're gonna start modeling. We're gonna have to go through that, and I don't think it makes much sense to start now, because then we're gonna stop and go. And I'd like you all to have your documents ready. I just want to make sure that all the stuff I need is in here. Okay, good. So we have the financial performance here. I just want to make sure that we have everything we need for tomorrow. Oh yeah, we have COGS. Good. Warehouse and shipping. Awesome. SG&A. A lot of detail here. This is good. Before we go, oh good, financial overview. Okay, good. This is all here. Excellent. What's the difference? So this is a good thing to end on, and we'll just kind of wrap up a few things. What's the difference between growth CapEx and maintenance CapEx? Anybody? Growth CapEx, maintenance CapEx. What is it just saying in the words that I'm saying? What's the difference in growth and maintenance?
Growth CapEx, money reinvested to grow the business, maintenance is just, I guess, keep it running.
Exactly. That's it. Did everybody hear that? Joe, you want to repeat that? Very important. Fine, you said it right.
Growth.
Be confident in yourself, Joe.
Money reinvested into the business to grow its maintenance CapEx, just keep it as it is.
Right. So if we have a certain level of earnings, let's say I told you, and we generate $10 million of earnings, $10 million of CapEx. That would be maintenance. We need $10 million generate. Now, if we want to increase our capital expenditures a little bit more, we want to spend a little bit more money, maybe we can get an extra return on our investment. All right. So that'd be the growth portion of it. All right. So we talked about a lot today. I mean, anybody have any questions?